Good morning. Welcome to another special load shedding edition of Sygnia Market Update webinar. I hope that load shedding hasn't impacted too many of you watching today. And once again, South Africa doesn't deliver. We deliberately scheduled today's webinar post-budget so that we could share our views with you on the budget, but it has been delayed for a second time to the 11th of November. So unfortunately, no update on the budget today, but a lot to talk about, another jam-packed session. Before we get into the market update, for those of you who missed Eva's webinar this month, and particularly for any investors in our signature range, our CPI unit trust range, or the Sygnia Equity Fund unit trust. A very big important announcement. We've added a fourth equity manager to our range of equity managers. So we've added Visio. We used to have, or we still have, Coronation 91 and ABAX. It's a blend of 3 equity managers. We've added a fourth. This is an important announcement because Sygnia generally has very long-term relationships with our underlying active managers. We believe that skill is persistent, and it's also very expensive to change managers. So we try not to do that too often. So this is a big change. We are excited about it. For those of you who missed the webinar, it's available on the Sygnia YouTube channel. So for those of you who don't know, if you just type into Google Sygnia YouTube, we've got our own channel with all past presentations, including this one afterwards, and all the ones that have been in the past, including Eva's on this change. It was also, the other announcement was that this Sygnia Equity Unit Trust, the fee's been discounted from 90 basis points to 50 basis points. So a very exciting low entry point to some incredibly strong active managers within South Africa. Jumping onto the market review, it was definitely a risk-on month last month. October, everything in green there, equity markets, commodities rose strongly, very nice, whereas the red refers to mostly bonds. So the bonds selling off in a risk month, equities doing well, and some fantastic returns. So balanced fund 1-year returns are high 20s, low 30%. So we're very excited about that from an absolute sense, that markets and balanced funds are doing very nicely, including the range of Sygnia funds. So that's very exciting to see. And we do think that the risk on will continue for the next 6 to 12 months, if not as buoyant as it has been in the past, certainly slowly moving up. So what was October all about? Well, the main market announcement and market news, and certainly what drove markets, was the energy squeeze and the concerns that may drive inflation. And what we did have was some concerns of that energy squeeze, and that might be caused by the move to ESG. And that certainly is not the case yet. It may happen longer term, but not right now. So we had the G20 in Rome, and Mario Draghi, who we all know very, very well, he was there, and it was all about renewables and just before COP26 and what to expect and what each country was doing. And here you see Draghi saying, we made sure that our dreams are not only alive, but they are progressing. Unfortunately, he was dreaming, because there was very, very little that happened at the G20. In fact, Russia and China didn't show up at all. Xi Jinping was not there, and China refused to increase any of their commitments to net zero. And China is the largest user of coal in the world, 4 times bigger than the next user of coal. So it's all about China. If China doesn't show up and China doesn't agree to do anything, well, then it's kind of a moot point. Anyway, it's been left to COP26, which is currently underway in Scotland. You know, all the big names are there, the Queen, the Pope, and of course Greta, but no China. So it'll be interesting to see what happened. And apparently it is the biggest summit since the Paris summit in 2015, even though this happens every 5 years, every year. It's the biggest one in 5 years. And it's quite important because each country is expected to present their NDCs, or their nationally determined contributions. So not only how much they're going to reduce in terms of carbon emissions, but how they're going to do it. So it'll be interesting to see what happens. But certainly if the G20 was anything to go by, not very much is expected to come out of it. The US with Biden there and no longer Trump means that there might be something more out of the US, but we need China to come to the party if anything meaningful is going to happen. Anyway, it's still too early in terms of what's happened with the world converting to renewables and green power to say that the energy squeeze that's happened over the last 2 months is a result of that move. Yes, it is on the margin, but certainly not. In fact, what happened was very much energy being at the center of a perfect storm. So we had China again, and China is the largest coal user and producer in the world. And China's electricity consumption has been at peak levels. So the demand in China is at peak levels. And the reason for that is that COVID has restricted the amount of money that people can spend on services. So they're spending on goods. So you can't go on a holiday, and you can't go to a restaurant, so you buy a new TV or you buy a new car. And that's fed through to the demand side on China. China at the same time has banned Australian coal imports due to a disagreement that they've had. And at the same time, they've had flooding and environmental restrictions which have limited their coal production. So China, with less coal than they need, they've turned to natural gas from Russia. Now, Russia at the same time is taking advantage of Europe's natural gas shortage. So Europe's having an energy shortage because they had lower wind-driven electricity over their autumn, and particularly cold autumn. So Europe didn't have their renewable energy production. They needed more power because it was cold. So they were asking for Russia for extra natural gas. Russia was saying no, Putin in particular, Putin was rubbing his hands and going, sorry, we can't give you any energy because we're giving it to China. But not to worry, if you sign Nord Stream 2, we'll give you as much as you want. Now that Nord Stream 2 is a bit controversial. It bypasses the Ukraine. It will actually displace some of the US supplies of natural gas into Germany. So there's a whole lot of reasons why it hasn't been signed and why a number of countries don't want to sign. They're concerned it gives too much power to Russia and to Putin. So it's all basically weather and politics that's caused the jump in energy and natural gas prices and coal prices over the last 2 months. And it's not that much about ESG. And despite energy prices having risen, that we're not as concerned that it's going to disrupt growth. In fact, we do think growth is going to continue. That's our base case. And if you look at the charts on the right there, it shows US energy consumption in power per real GDP in trillions of dollars. And basically, it means the world is a lot more energy efficient than it was. Fossil fuels represent only 2% of GDP in the EU, down from 5%, and the lowest since 1999. The US generates nearly 3 times more more GDP per joule of energy than it did in the 1970s. So the world is becoming a lot more efficient in terms of its energy production. So spikes in energy prices don't have the same impact like they did in the 1970s. So what does this mean? Well, it means that the world is going to continue to grow. We're not too concerned about growth being disrupted. Prices will stabilize, oil might go up a bit, and natural gas and coal prices will come down, but the move to green is going to slow down. And we're seeing that already. So while we're going through COP26, the UK is busy producing power from coal at the highest level it has in 8 months. China has instructed 170 coal mines to expand production. Now, South Africa only has 19 coal mines. China is expanding 160 coal mines. So you can understand the scope of what's happening in China in terms of power is more important. People need to have electricity at home. Yes, it's great to look at renewables, but when the lights go out, people panic and you need power. At the same time, the US rig count has risen, so we are going to see an increase in supply for oil, which will help stabilize the oil price, and OPEC will increase production of oil as well. But the other side is that the solar polysilicon prices have reached the highest level in a decade. And again, people are very happy to switch to renewables, solar and wind when the prices are very competitive. But when you've got solar prices jumping to the highest level in a decade, it's bound to slow down that production, because it puts into a stark contrast the E and the S when looking at ESG. Everyone loves governance. That's not a debate. But and when renewables are the cheapest energy production, well then E and S are aligned, because you can create cheap energy while benefiting the environment. But when renewable prices spike, well, there's a conflict, and that's what we're seeing right now. So we'll see what comes out of COP26. We don't think that renewables are a cause of the global energy squeeze, not now, certainly, maybe in the next decade. But I think when it comes to politicians like to protect their jobs, and that means keeping the lights on. And so the green drive will always be second, which from a growth perspective, I suppose at least is positive, means the lights will stay on, growth will continue, and we don't think that this will disrupt the markets over the next 6 to 12 months. So moving on from the energy squeeze, which impacts inflation, and it's all about inflation. So the long-term outlook and the short-term outlook and the medium-term outlook all depends on our views on inflation. So the US central bank, the Fed, they've gone from inflation being transitory to inflation being transitory for longer. And that certainly was our call. We thought that inflation would be a little bit more sticky than people thought, but we still do believe that it's very much COVID driven and that it's not going to last forever. So we had recently, we had US 5-year inflation break-evens reach their highest level in 20 years. The markets are concerned about inflation in the short term. So that there's no doubt that what's happening in the energy squeeze and supply bottlenecks, shipping rates, that's impacting inflation expectations, particularly in the US. But what's causing that inflation? That's what is most important. So firstly, it's coming through from the demand and the supply side, but on the demand side, it's COVID driven. So if you look at the top right chart, you'll see their services, a relative trend, that's the brown line, that's still below trend, whereas goods, that's the green line, that's above trend. So COVID came through, as I said before, with mobility restrictions and lockdowns. You could sit at home and buy yourself a new TV, but you couldn't go out to a restaurant and you couldn't go on holidays. So people spent a lot more on goods, a lot less on services. But that peak is already rolling over. So you can see the green line is coming down and the brown line is going up. So that reverse on the demand side is already slowing. So we do expect that to continue as mobility improves. People start to spend more on holidays, more on services, and less on goods, because everyone's now bought a new car and a new TV, and so that will be in the base, and that will roll over. At the same time, the supply bottlenecks have also been very much COVID driven. So the mobility restrictions have closed down ports, they've closed down mines, they've closed down factories, and all those closures have led to a reduction in supply, which is what's caused the prices to spike. But that again, as vaccines are rolled out, as herd immunity comes through, that is going to dissipate. The world will learn to live with COVID. If it stays here for longer, they will find ways to work around it. But the base case seems to be that the Spanish flu was only around for 2 years, 4 waves, and that COVID is likely to be the same. The fourth wave will be the last meaningful wave anyway. So, our base case scenario is that while stagflation is a risk, that while growth is being downgraded and inflation is being upgraded as a result of these demand and supply factors, shock factors as a result of COVID, we will work through it. Another data point which just shows that this is very specific to what's happening is the amount of fiscal and monetary support that has happened as a result of COVID. So if you look at inflation, we're looking at the bottom to right-hand chart now. The blue line shows US inflation, which has peaked close to 5%, and the rest of the world inflation, which, while it's up, is nothing too serious if you look at the last 20 years. What is the difference? Well, the US inflation is at 4%. UK inflation is at 3%. Compared to that, China is at 0.8% and Japan is at 0.2%. What's the difference? Well, in the US and the UK, people were paid not to work. There was the furlough in the UK. In the US, there were checks. Money was literally printed and put into people's bank accounts. And people said, well, why should I take on low-paying jobs? Why should I work as a waiter if I can sit at home and earn more money? So there's certainly been a wage spike in that lower end as a result of the huge monetary stimulus that has happened. But that's going to come to an end as well. And so those countries will see probably a faster decrease in their inflation as people go back to work and as the increased supply in the labor force reduces those wage demands. It might take a little bit longer. Wages tend to be more sticky than other forms of inflation, but over the next year or two, that should come down. But again, it's a great data point to show how not only has the supply side in terms of disruptions and the demand side in terms of extra demand for goods, but also this huge amount of stimulus that we put into the system as a result of the governments trying to protect their constituents, that has driven this very anomalous inflation that has come through. And as it all works through the system, it's likely to feed through, and inflation will turn to disinflation. And we still do believe that with a huge amount of debt and aging demographics and financial repression, we are generally in a disinflation world and not an inflation world. And looking to that, I mean, the big concern in markets is that inflation will be here for longer because central banks are behind the curve. So the Fed certainly is behind the curve. They're letting inflation come through. Fed announced tapering. So the big news this week was the Fed announced its taper. They're going to start buying less bonds. So they're going to be buying $15 billion less a month in terms of the amount of QE support. So still buying a massive amount each month, but buying less, and hopefully by mid next year that will go down to just reinvesting what's on the balance sheet. Not selling it all, but still buying, but only buying the coupons. At that point, the Fed will look at raising rates. So that is definitely behind the curve. The ECB, we had Lagarde come out to say, she said the ECB is very unlikely to raise rates next year. The BOE, England, was supposed to raise rates yesterday, highly expected given the inflation, and they didn't raise rates. So the whole world is behind the curve in terms of raising rates. The whole world is, central banks around the world are looking through the inflation, which is great. It means that growth will continue, because what causes recessions? Recessions are caused by central banks raising rates too quickly, and that disrupts growth and raises the discount rate for stocks and bonds, and it causes a decrease in valuation levels. So with the rest of the world, central banks being very cautious in their rate hikes, the next 6 to 12 months are going to be good for equity markets. The concern is that they're all behind the curve. The concern is that in 12 months' time, because they haven't raised rates early enough, that inflation will become sticky. There'll be a panic, very fast and very aggressive raising, which will push us into recession. That is definitely a risk. It's not a likely outcome, but it is a risk. We think that inflation won't be sticky, but it is something that won't be known for the next 6 months at least. So right now, with the world central banks being dovish, it's very hard to fight them. And we think that a recession over the next 6 to 12 months is unlikely. So stagflation is a risk, but not a likely outcome. The energy squeeze is not going to derail growth. We do think growth is going to continue, and inflation will, while it'll be with us for a while, will eventually come over. So let's look particularly at the US to see what's happening there. The US has been the winner over the last 13, 14 years. So the chart here, the top line in the dark green, I'm told, it looks black, is the US. So the US over the last, relative to the world equity markets over the last 13 years, up 60%. The rest of the world, developed world ex-US, is the dotted line, and the EM world in the lighter blue or green line is emerging markets, both down about 40%. So it hasn't been about developed markets or emerging markets. It's been very much US versus everybody else. US has been exceptional over the last 14 years. And that's been driven by technology stocks, and it's been driven by the dollar. The dollar certainly remains overweight, expensive, and we are concerned that the dollar is expensive. But it's also driven by tech. So Tesla this month joined the $1 trillion club in the US. It is now the 5th US company to have an over $1 trillion market cap, joining the likes of Apple and Amazon. What is different, though, is if you look at the other four stocks that are over $1 trillion in the US, their average PE is about 30. Average price to earnings ratio is about 30. Tesla sitting on a PE of over 300, so it's 10 times its peers. And in an environment where you've got Apple and Amazon both entering the EV market, it's quite hard to understand, but it is what it is. But it certainly speaks to our concern that the US valuations is one of our concerns, and it's one of the reasons why we are underweight US equity markets. Antitrust issues are another one. We've seen what happened to Facebook recently, who've now renamed themselves as Meta, because obviously if you rename yourself, then all your problems go away. But there's been some poor outlooks coming through, earning outlooks coming through from Apple and Amazon. So there could be some headwinds to those large tech stocks, which make up so much of the US market. But another data point that I'd like to add this month, just in terms of why we are negative on the US over the next 10 years, is the US's freedom in the world score. So over the last decade, the US's freedom in the world score has declined by 11 points from 94 to 83. And that was a result of them falling in three categories. Firstly, political corruption. Secondly, lack of government transparency. And thirdly, punitive immigration policies. So what is very interesting is that JP Morgan have analyzed countries over the long term, and they've realized that countries that are downgraded over the next decade underperform countries that are upgraded by 5% per annum over the following 10 years. So this is not the reason why we are underweight the US, but it does talk to all that's going on in the US and the fact that it doesn't bode well to the outlook, and particularly not so much equity market in a domestic pricing term, but a lot of that, majority of that underperformance comes through from a currency perspective. So it does talk to the US dollar, which is probably 20 to 30% overvalued compared to other currencies, and we could likely see a lot of that unwind over the next decade, driven partly by fall in their freedom in the world score. So we remain underweight US, we remain overweight Europe, we remain overweight Japan and developed markets. We also continue to remain overweight emerging markets. We think that's what is happening in China is a good entry point. Yes, China has a lot of emerging markets in general have a lot of volatility, and it may not be a buy and hold strategy, certainly not the overweight portion, and we do trade those markets quite aggressively, but certainly the volatility gives you a great entry point. So we think right now is a great entry point to China and emerging markets. So unfortunately, the bad news continues in China. So China is still struggling with negative news from tech regulations or concerns that those regulations will be extended. China is still struggling from Evergrande default, even though a number of interest payments have been met. And now we're seeing that Chinese house prices fell for the first time since April 2015. So that is quite a concern. And the reason for it is quite obvious. China, in its desire for common prosperity, is trying to cool the house price. So when houses are expensive, China wants to make sure that everybody can buy a house. So they want to try and cool house prices, which is great for those who don't own property, gives them a chance to get in. Of course, when you own property, it's not so great. And majority of Chinese wealth sits in property values, with housing representing more than 50% of consumers' total assets. So there's going to be a balance where a cooling of the house pricing in China, while good for those who are getting in, does impact the wealth effect of those who hold property, and that may lead to a slowdown. But at the same time, it's all driven by government policy, and it can be reversed or slowed down as required. So, what is interesting is knowing, governments know what needs to be done and then implementing it. So you probably have maybe the most accepted practice is the US, where the government knows what needs to happen. That policy takes quite a long time to be approved. So if you look at what's happening, antitrust in the US may take 5 years for something to be approved. Markets get sufficient timing, they know that it's coming, and it reduces the volatility that exists in the markets. South Africa, on the other hand, we know what we need to do, execution never happens, and we never get anywhere. The other extreme is China, where they know what they need to do, and it happens overnight. in an extreme fashion. And that leads to a lot of volatility as markets have no time to anticipate what's happening. And that is shown quite well in this bottom right-hand chart from the Financial Times, which shows that bear markets happen most years in Chinese stocks. Over the long term, you are rewarded for that volatility, and there's a very good return from the Chinese stock market. But because of the nature of implementation of Chinese policy and the fact that it catches investors by surprise, there's a lot of volatility. So it gives you an opportunity to buy in. We only went overweight China after the 40% fall, and we are nicely in the money on our position. We are going to hold it for a little bit longer, but it's very much, when it comes to China, it's about using those opportunities. And already Hong Kong's Alibaba is up from its lows. It's gone from the biggest loser to the biggest winner. Hong Kong property stocks are up 18% from the September lows. So that volatility is already reversing, and we think that it will continue to reverse. And while there's a lot to be concerned about from a China perspective, from the government's policy, if you look at a bottom-up perspective at the underlying companies, there's a lot of value. So the top right-hand chart shows, and the vertical axis, that's valuation, how expensive are companies. So the more expensive, you expect you're going to be getting more growth, but growth, which is on the horizontal axis, it actually gives you the reverse impact. So Chinese onshore companies, and that's very much internet weighted with Alibaba and Tencent. That's actually the cheapest region on this chart, despite it having the highest growth. Next cheapest is China A-shares, the Chinese onshore market. That wasn't as impacted by the latest round of regulations. That's got the second highest growth while being the second cheapest. And then you can see here the USA got the most expensive valuation, even though it's only got a medium growth outlook. So certainly a lot of value, and we are being paid to take on that additional risk. Now, we're not only overweight China, but you need to be overweight China if you want to be overweight emerging markets, as they make up about a third to a half of emerging markets, depending on which index you use. But we're also overweight emerging markets because the biggest risk factor that we were worried about was the Fed tapering. The taper tantrum that happened in 2013 was very negative for emerging markets. We weren't concerned that it would be negative this time because of a number of factors. One, the Fed has well telegraphed the latest taper. But two and three, or secondly, in 2013, emerging markets had current account deficits. South Africa was part of the Fragile Five. Now, the average emerging market current account is in surplus, including South Africa, so a lot less fragile. And commodity prices are very bullish for emerging markets. Commodity prices are still quite elevated. And lastly, foreign bond ownership is a lot lower than it was. So there's a lot less hot money for foreigners to quickly pull out of emerging markets. Anyway, the taper happened. It was announced this week, and instead of a tantrum, we had a rally. So this case was actually sell the rumor and by the fact that everyone was holding back until the tape happened. And since then, emerging market currencies, including the rand, emerging market equities have rallied, and we think that risk on will continue for some time. So along with our positive view on growth, the fact that the major risk is out of the way in terms of the Fed taper and central banks are being dovish across the developed market world, Japan, Europe, and the US and the UK, it supports our pro value because we do think real yields will rise. It supports our pro risk in terms of being overweight equity, and supports our overweight EM in China in terms of the cyclical bounce that they will enjoy as growth recovers. So that's the good news. And now we're on to South Africa. So here we have the head of the ANC's election campaign talking about our dear president, Cyril Ramaphosa, saying that were it not for the kind of president we have, the ANC would be at 30%. As it is, the ANC dropped below 50% for the first time in the recent municipal elections, down to below 50. The DA also lost quite a considerable vote from 26 or 27% down to 21%, while the EFF gained 2%. But the most telling thing about the elections was the voter turnout. So the voter turnout dropped from 58% in 2016 down to 44%. 44% of the 26 million registered voters decided to vote. And that certainly is evidence of how tired voters are about the lack of service delivery from no matter who they're voting for. They now vote, they've given up. It doesn't matter who you vote for, you don't get service delivery. South Africa doesn't deliver. That is evident when you look at South Africa's place in the World Bank's ease of doing business index. That's the top right-hand chart. We have fallen, even though the number's gone up, but we've worsened quite considerably. We were 34th out of 190 countries in 2010, and we've dropped down to 84th place over the last decade. And you can see there that's the bar graph that shows dropping from 34 to 84. The line there shows you unemployment rate, which has risen from 24% to 35% over the same period. And there's no doubt that there's a correlation that as it becomes harder to do business, people don't do business, and so they don't hire people, and there's no wage growth and unemployment rises. Now, two of the biggest factors was Eskom, load shedding, and Transnet's transport delays. So you're not going to open up a factory if you have no power. You're not going to open up an import-export business if you can't get your goods delivered to your warehouse. So clearly, the two things that need to be repaired for our growth to recover. Now, while we're saying that we're currently on load shedding stage 2 right now, we hit load shedding stage 4 over the last month, which is terrible, very, very sad. We had Andre de Ruyter coming out to say that it's a result of incompetence and corruption, which is not great if the CEO of Eskom is blaming it on those two reasons. He's saying that he's one man and he can't fix incompetence and corruption on his own, so the government needs to help. And unfortunately, there's no quick fix. So the good news is that the Renewable Energy Independent Power Producer Procurement Program, and the length of that title is completely correlated to the length of time that our government takes to get anything done. But anyway, REIPPPP round 5 was announced, which is great. Unfortunately, those bidders now have 6 months to get their finance and project agreements in place, so there will be a while before they can even start building. But despite that, it's most likely they'll be ready before the emergency round is ready. And hopefully that means that the emergency power round gets cancelled. So if you remember, the emergency power round has been delayed because of legal action around Car Powership, who won the majority of that round. So you're looking at renewable energy round 5 happening sooner at a much cheaper rate and being fully green. The emergency round was natural gas, so it wasn't clean, it was very expensive, it had some crazy 20-year contracts, and it's been mired in legal and corruption concerns. So let's hope that it doesn't happen, but we'll see either way. Either way, it's going to be a while before we have the next round of power coming online to assist us with load shedding, which is not great for growth. We did have at the same time, we did have an announcement of the infrastructure projects, which is great, and the second draft regulation 28 came out, which is also very positive. So just having a quick look at that for people in terms of your pension funds and retirement funds and how the impact that it has. Right now, investment in infrastructure is completely voluntary. There's no prescribed assets, so you don't have to worry about that. It will be invested on a voluntary basis if the risk relative to reward payoff is good. The definition of infrastructure has been broadened very nicely, so that is a very positive outcome of round 2, second draft. What didn't happen was they didn't increase the limit to private debt. So private debt is still limited to 15% of your 100% of your retirement fund. Private equity was extended to 15%. So that then assumes you can have a 50-50 funding of the projects from a debt to equity perspective, which is not the case. Look globally, most projects, given their long-term nature, are funded on an 80-20 basis. But given those limits, it's probably unlikely that we'll hit the 15% limit anyway, so it's not a major cause of concern. The bigger issue is supply. Everyone is very excited and very keen to invest and support the country and get great returns and get projects that are implemented well, but the delay in, even the soonest that should come online, which is REIPPPP5, we're looking at least 12 months before that goes into construction. The other interesting point that came through in the second draft Reg 28 was the banning of crypto assets. That certainly is quite interesting. Sygnia has been struggling for quite some time to give our investors access to crypto assets. There has been a reluctance because of the risk, and I'm not saying that there isn't risk. It is certainly a risky investment and needs to be approached with caution. But it has been blanketly banned. You can't, even in a 2.5% other, where you can invest in art, which is equally risky if you ask me, or wine or anything else. You can invest in art and wine, but not in crypto assets, except for central bank digital currency, which is certainly something that is becoming more and more accepted. China wants all tourists to their Winter Olympics in February to spend using their digital currency. Sort of interesting to see the adoption of that, but it's definitely something that is coming soon. And Reg 28 does allow investment to that, but not into Bitcoin. Last but not least, on this chart, the second bottom right-hand chart is real GDP per capita. So not surprising with the lack of execution, the lack of service delivery over the last 15 years within South Africa. South Africa's GDP has been flat in Rand terms. So flat in Rand terms over the last 15 years, and that the GDP per capita is a proxy for the average living standard of a country. So if your GDP per capita rises, everyone is on average is slightly better off. So instead of being able to afford one microwave, you can afford 2 microwaves. Unfortunately, within South Africa, no one is better off for the last 15 years. If you could afford 1 microwave, you can now only still afford 1 microwave. And the OECD put out this chart saying that South Africa is the second worst in the world in terms of our average living standard, only beating India. We have a worse Gini coefficient or inequality, but on average, we are worse than in everybody except for India. And what is unfortunate and what is rather worrying is that the OECD has said what South Africa needs to do to improve those living standards, and it particularly revolves around labor reforms. But at the same time as saying that, they don't expect anything to happen, and so they're not projecting any improvements in our living standards because they don't expect any reforms to happen. And so the little black triangle that you can see there above the blue line is our average living standard or GDP per capita in 40 years' time. And we stay pretty close to the worst over the next 40 years. India improves very nicely from last place. In fact, their living standards look like they'll double over the next 40 years. South Africa not so fortunate. So once again, we remain underweight South African equities. We remain underweight the Rand because we need reforms to take place. We need South Africa to start delivering. Yes, Cyril has done a great job in terms of tackling corruption and making sure that there is less corruption than it was in the past. And that's why the ANC is sitting at 46% and not 30%, as my opening slide said, but still the country as a whole needs more to happen faster. And we'll wait to see what happens. Until then, we remain underweight South African equities and the Rand. The good news, and there is lots of good news. So that was my bad news slide in South Africa. This is my good news slide in South Africa. We are very overweight South African bonds and thinking of even going further overweight South African bonds. So one reason is return. There is a massive buffer built into the South African bond market. So South African bonds are mostly driven by two factors. Supply is the fundamental factor, but that's more of a longer term factor. The short term are driven by US bond yields and the rand. So the negative side is that US bond yields are likely to rise over the next 6 to 12 months. So we actually don't have global tailwinds anymore, we've got global headwinds. But there's a huge buffer priced in, so we're not too concerned about that. The other factor is the rand, and we don't think the rand's going to weaken significantly from current levels. In fact, I think the rand's a little bit cheap at current prices, given where commodity prices are and given what our budget's going to do. So we do think the rand will come back a bit. But mostly, it's the risk. There's a huge buffer priced into our bond market, which is expecting a very poor budget over the next decade, expecting very poor fiscal responsibility over the next decade. And that means that even if it is poor, the risk is priced in. So you're getting 10% yields on South African bonds, which is just phenomenal, compared to 0 in Europe, 0 in Japan, 1.5% in the US. It's a great yield. It's the best in the world, basically, just beating Brazil. And Brazil have got a host of their own concerns. So yes, while I'm very negative on South Africa, and I talk about corruption and lack of service delivery, as an emerging market, we don't stack up too badly against Russia and Brazil. So that needs to be taken into account. Anyway, so we are overweight South African bonds for the fact that the return is very good, that there's a huge risk buffer built in. But also we think that the budget that's going to come up, the second delayed budget that's going to come up on 11th of November, isn't going to be too bad. Expenses are going to be higher than forecast, but GDP was revised higher, and there's a massive revenue surplus because of great commodity prices. So not anything that we've done well, and not due to our own benefit, but we've been lucky, and we are enjoying windfall tax revenues because of the commodity boom. And as a result, the budget should be okay, certainly in November, and maybe even in February, depending on what happens. Hopefully, there's no political influences to the budget as a result of the lower turnout, not the lower turnout, but partly the lower turnout, also the ANC dropping below 50% and the desire to increase those numbers. So certainly some political risk in the February or longer term budgets. But in the short term, we don't think so, and we think that bonds are certainly well priced. We've also got, what's also a positive is we've got a current account surplus, in fact, the highest it's been in 20 years, and that's likely to stay positive for the short to medium term, along with, as a result of the commodity boom. So that's positive. The other reason to be positive on South African bonds, the major risk was the taper tantrum, and the US taper is behind us. There was actually a taper boom, not a taper tantrum. The election risk is behind us, and the only risk that is remaining is the budget, and that we don't think is going to be a huge risk. So the risks are mostly behind us. The return is still looking phenomenal, and we think that it is a good time to be overweight South African bonds. And as a result, we are overweight South African bonds in our balanced funds. We are overweight South African bonds in Income Maximizer, and that's got a really decent yield, a current yield of 8.9%, and that excludes any capital appreciation. So if bonds do strengthen over the next 12 months, which is our base case, you could be looking at a 10% return within that portfolio. So certainly quite juicy yields in the bond space. So that brings us to positioning. And before I go to our general positioning slide, I thought this was quite interesting. I just want to talk briefly about these two graphs and just the changing opportunity set. So last month I spoke about our rule of thumb, the fact that it should have roughly 1/3 global equities to 2/3 South African equities. That remains the case. So I'm not changing that outlook. But we did have a quite strong increase in queries as to why South African property isn't one of our asset classes in our strategic asset allocation. So across all our balance funds, we have global equities, global bonds, that's global cash, South African equities, South African bonds, South African cash. We don't have South African property. So the question was, well, South African property was the best asset class over the last 12 months. Why didn't you guys have any? And that is true. It has been the best asset class over the last 12 months. Still the worst of the last 2 years, but the fact remains that we don't have any. So why don't we have any South African property? Well, South African property we do have because it is in the ALSI and the SWIX, the cap SWIX, and it makes up about 4%. But the reason we don't have it as a separate asset class is it's only 4% of the equity market, so it's tiny. And it's not diversified. It doesn't give you any different return to South African retailers or South African banks. They're all highly correlated. And we are looking at an environment where not only is South African property tiny in the South African context, but the South African context is becoming tiny. I mean, if the bottom right-hand chart, South Africa makes up only 3% of the MSCI emerging markets, China making up over a third. You can see there, in around early 2000s, South Africa was close to 10% of emerging markets. We made up a significant chunk, but we continue to shrink. And South African property is a similar impact. It's shrinking in its diversification benefits, and it's shrinking in its size. So we don't have South African property as a different asset class. We do have global real estate as a separate asset class. And that brings me to the top right-hand chart. So the top right-hand chart shows the shrinking number of listed equity available investment opportunities. So the number of US listed companies has shrunk from about 8,000 down to 4,000. So it's halved over the last 20 years. At the same time, looking at the JSE had nearly 800 companies listed in the 1980s. That's now down to below 300. With only 100 shares that really are investable, with market cap over 10 billion. So you've got a shrinking listed pool, and that's reflected in the growing pool of alternative assets. JP Morgan estimated that in 2021, so this year, that your listed equity makes up 48% of the global universe, listed fixed interest 39.5% of the global universe, and alternative assets 12.5%. Which has grown from 10% over the last decade. It's not a huge growth in percentage, but quite a huge growth in the absolute number. Looking into that breakdown, the latest data point shows us that nearly half of alternative assets are made up with global real estate. So we do have global real estate with the Sygnia global property ETF. We do invest in that, and that makes up global real estate makes up nearly half of alternatives. Next is private equity at a quarter, 25%, and that's where we have exposure to our OSI, which is private equity. Private credit is only 5%. That is quite small, but we've got quite a big chunk of that in South Africa in terms of our enhanced income fund, which a lot of that is private credit, and certainly infrastructure will count as private credits going forward. Hedge funds make up 15%. We don't have any exposure to that because hedge funds remain expensive. If we can get a hedge fund to give us lower base fees with the same performance fees, we'd be happy to invest. And digital assets, 10% of the universe. So remember, this is not what a pension fund's average holding is. This is the available universe. So they just looked at what can you invest in, and what is the market cap. So given the exponential increase in digital assets, Bitcoin, that digital assets has grown from 1% to 10% over the last few years. So that is what is available, not what is invested in. So we do think it's not really necessary to have SA property as an asset class within South Africa. It's a tiny amount of an insignificant number that doesn't provide you the decent diversification. And while it's had a great bounce over the last 12 months, it's a bounce off quite a distressed low number, and we still think that there's structural headwinds in South African property. Yes, it is looking cheap relative to NAV. It's being priced at a discount to NAV for the first time in a long time. But at the same time, distributions are unlikely to grow for the next 3 to 5 years. So we're happy to include some of that for a yield basis, but none of it from a growth basis, and therefore not in our strategic asset allocation. So that brings us to our usual positioning slide. we can see that we do have a small allocation to global real estate. That's our bond alternatives. We don't have any global bonds. The two worst performing asset classes year to date are gold and global bonds. We don't have any of those asset classes because we do think that we're in a cyclical bounce. And that bounce we thought was only going to last until the end of this year, but it's been delayed because growth continues to be slower than expected, which is also good because it means markets are taking longer to become overheated and central banks can take longer to raise rates. So part of that is us remaining overweight value. So that's quite a big, you can see there are 3 pluses. We overweight value locally with the Divi Fund. We overweight globally with the MSCI Value ETF. And we have in the US, so it's the MSCI Global Value. And in the US, we've got a US value instead of US to give us exposure to US banks, US industrial stocks, which we think will both outperform US tech stocks, particularly the FANG stocks, over the next 12 months. At the same time, we do think US small cap will outperform US large cap, and that's why we've got exposure to the fourth IR, Fourth Industrial Revolution Fund, instead of S&P 500, and that's why if you pop over to the right-hand side here, disruptive technologies, we've got a small plus to fourth IR. We don't have any exposure to FANG just because FANG has become such a big part of the universe. So half our global exposure, even though we're underweight, is to the US, S&P 500, and the dominant driving force of S&P 500 is the FANG stocks. Even MSCI World, on a look-through basis, is dominated by the FANG stocks. So we don't think we need any extra exposure to that right now because there is a lot of exposure to it. Not that we don't like the companies. We think that they're fantastic businesses. They've got super moats. I mean, Apple really is just an amazing business. Amazon is an amazing business. They are expensive with 30 PEs, and they will face some headwinds with US rates rising. But long term, they are great businesses. So we're happy to have them in the portfolios, but we've got enough of them. We don't need to go overweight them right now. Emerging Asia, we are very excited about in the short term. So we've got our own, the Sygnia Emerging Market 50 ETF, which continues to do well. We also have China A-share onshore exposure. We've also got recently bought after the 40% fall. We've got MSCI China, which is basically your offshore liquid Hong Kong-based Chinese tech stocks. So that's 44% of that is internet stocks dominated by Alibaba and Baidu and Tencent and the like. So that we have got a short-term holding in that due to the fall. We also are very excited to announce that in the month of November, we will be launching the Sygnia China New Economies Unit Trust. I think this is a great time to get exposure to China. We're very excited to launch it. So we'll be launching that towards the end of the month. And that has there will be a webinar on that. Nikki Davidson will be running that webinar, talking more about the details. But we've got, it's called the Sygnia China New Economies Unit Trust. So it's very much focused on the parts of the China economy that the government is supporting. So in China, as I mentioned before, a lot of volatility, very impacted by Chinese policy. So you look at the Chinese 5-year plan as that has evolved, the myriad of 5-year plans. 10 years ago, they started focusing on consumption-driven economy as opposed to export-driven. And the most recent one, they're focusing on R&D and tech spend. So you want exposure to the domestic economy, the consumption economy, the technology-based economy, because that is the part of the economy that the Chinese government wants to grow. And that's what that unit trust focuses on. We're very excited about that unit trust. And then healthcare, we remain overweight from a structural perspective. We think that it's a great place to be growing spend on healthcare, aging populations, innovations coming through in that space in terms of a number of breakthroughs, not only COVID-19 related, but cancer related and aging related and new surgery techniques. So we are excited about that. From a long-term perspective, we have exposure to our Sygnia Health Innovation Unit Trust, the Sygnia Health healthcare ETF, Sole Active Healthcare ETF, and obviously our OSI holding is also overweight. And then the core, the passive portion, underweight South African equities, overweight South African bonds, remain overweight global equities because that's where you're getting uncorrelated, diversified opportunities and growth opportunities, and underweight global bonds, as I've mentioned. So that's where we are. See that it's nearly 12 o'clock. Let's have a look at the Q&A quickly. Yeah, there's a great question on our ESG approach. So ESG is core to our investment process and our philosophy, and we include it whenever we're making any investment decisions and any rolling out new products and deciding what is important. Globally, as you can see by the recent G20 and COP26, the focus globally is very much on carbon emissions. It's about net zero. It's about achieving the 1.5% degrees Celsius target and temperature rise. So that's why globally we focused on a passive approach mostly. So we're invested in the S&P 1200 Global ESG Equity Index, and there's a very strong carbon emission focus as well as the full ESG suite of governance and social impact. But the major driver there is carbon neutrality and avoiding the big carbon polluters, as well as not investing in tobacco and weapons and a few controversial things that are excluded. So that is the global focus. Globally, we also have our impact fund, OSI, which is very much focused on changing the world from a positive dynamic. So new technologies that will improve the sustainable economy. And at the same time, we are within the fourth industrial fund. There are technologies in that fund that are also proactive in terms of looking for technologies that will bring about a better future. So those are our sort of proactive ESG measures. Fourth IR, and we are launching a new fund in that space that is focused very much on sustainable economies and OSI. And then on the passive side, it's with the global our ETF, the S&P Sygnia Itrix S&P 1200 Global ETF. Sorry, let me just stop the share. Forgot to do that. So that is the global approach. Locally, it's a very different scenario. We have had Brady Mantasha come out to say that South Africa can't look at renewables too aggressively, and that we do need to continue with coal mining. And that's an example of a responsible investing approach to ESG. So globally, you can focus very much on carbon emissions from a developed market perspective. Emerging markets who are not as a great polluter, or from a carbon emissions perspective, from an absolute number, there the focus is more on the social side and not the E. So there, I think, within South Africa, our focus is very much on infrastructure, job creation, where possible, including the E, so renewables, but it's a different focus. So we are looking very much at supporting the S locally for a number of funds, whereas globally it's more the E. So, and I think when it comes to ESG, there's no right answer. In fact, well, more importantly, there's no one answer, because it'll differ depending on who your investors are. And different investors will have a different weight on E and S and G. Everyone thinks that performance is easy because performance should be higher, not than lower. And everyone thinks that governance is important, better governance, not worse governance. But depending on who and where you are, E and S have definitely got competing views, and there is no one answer. And that's why I think it's going to be very difficult to have prescriptive ESG targets, because each individual investor, both institutional and retail, from your retirement fund to your discretionary savings, will have different focuses on what they think is important for their portfolios. John, I'm embarrassed to say that I don't have more information on the living annuities. Please, John, email Cher. Her details are here, and ask her what is happening, and I'll follow up with her directly as well to make sure that we do get you an answer on our living annuity SARB story. There's a small chance that that will all go away in the budget next week if they do allow a higher offshore allowance, but I'm not holding my breath for that one. Shah asks how often our bond unit trusts distribute their coupons and income. And actually, I'm sure, unfortunately, I don't know the answer to that. So also, if you can email Sher, she'll make sure that you get an answer to that. I think it's quarterly, but I'm not sure. John also has a question on bonds. So yes, bond yields have, unfortunately, because they've risen recently, bond prices have come down. So we did have a negative return in September in our income maximizer fund because the bond yields rose, and as a result, the price went down. This is a short-term volatility that we expect to happen. It was driven very much by the concerns that the taper tantrum would happen, and concerns about a violent election, and concerns about the budget. Two of those three risks are past. Already the bond yields are have come down quite nice. We've seen some very positive capital gains over the last week since we've moved past the taper tantrum. I think bonds should continue to strengthen over the next while, assuming a decent budget, and that should lead to a reversal of those capital value falls that we saw in September. In terms of our available funds, if you want to invest in bonds, we don't have an ETF. We've got 2 unit trusts. We've got the all bond index unit trust, which is currently at a 0 fee basis. You can buy that now, and it's 0 fees until the end of 2022, or you can buy the enhanced bond fund, where there is a fee, but you're getting additional credit yield. So that's why you're getting a 10.3% yield on the enhanced bond fund through a credit pickup versus a 10% yield on the bond index unit trust, or 2 unit trusts that you can choose from if you'd like to get exposure to these amazing yields that are currently there. Certainly some volatility exists, so it's not a 1-year time horizon, it's a 2 to 3 year time horizon, maybe a little bit longer depending on your risk profile, but that's certainly amazing yields compared to cash. Okay, so Wayne's got a great question about the increase in interest rates and what that should do to bonds. So the SARB, what is interesting about South Africa is the SARB model is very hawkish. The SARB are predicting a 3% increase in the repo over the next 2 years. So going from 3.5% to 6.5%. Now that's at a time when the 2-year and 5-year inflation expectation numbers are sitting at 4.5%. So inflation expectation numbers are exactly where the SARB wants them. So the SARB doesn't need to raise rates to squash inflation expectations. Yes, we do need to increase real yields, but I don't think we're going to have as a higher increase as they're expecting. The rest of the emerging markets are increasing rates. So Turkey's increased rates, Brazil's increased rates quite aggressively, and so I do think we will increase rates, but probably 2%, and I think we'll start in this month. But I think there's room for South Africa to be less aggressive than the SARB is predicting. So maybe a 2% increase over the next 2 years, not a 3% increase over the next 2 years. What happens then in that case? Well, cash becomes more attractive once the rate hikes have happened. In theory, what should happen is that higher rates decrease demand, economic demand, because people have to spend more money on their bond payments and their interest payments, and so they can spend less on discretionary goods. They can't buy as many TVs. So in theory, that means your inflation comes down, and that means that bond yields should come down. So in theory, the way economics works, as interest rates rise, the bond curve should flatten a bit, and you should get capital gains in your bond market. At which point you can possibly bank those gains because you'll have a lower yield on bonds, and you can move into credit or cash. That's in theory. Obviously, in practice, bonds are impacted by a lot more other factors, such as the supply that we'll find out with the medium-term budget policy statement, the rand, and global rates. Let's see. So Julian's put through a couple of part questions. I'm going backwards. I'm just trying to find the first question to understand that. But let's look at Wayne. So Wayne, your question on tech and the outlook for tech and regulations. In the long term, we do think that technology is here to stay, that they are the fourth industrial revolution, and that for the next the next decade at least, they are the major growers of market share. But I do think that while regulations have been mostly priced into China, the regulations haven't been priced into the US as much. So I do think there's more risk in the US from a regulatory perspective. But that's short-term risk. Long-term, we do think that the US is one of the cleanest shirts in a dirty laundry basket, and so we do remain, at least half of our equity exposure is to the US. SIG EMF is an emerging market ETF. So as a result of that, it's got just under half is China. It's also got exposure to the rest of the emerging markets, which is why it's done very well. It's very nicely diversified, and those other markets are also showing exciting growth. There's very good reasons to hold the other Asian countries that sit within the emerging market. The China exposure it does have is China offshore, because it is the MSCI basket, so it's China offshore, not China A shares within our ETF. Yeah, Christopher Gilmore's got a great question, and there's no answer yet. It's asking, is there a structural change in employment in the UK and the US as a result of furloughs and money being printed and given to people to get them through COVID? Will people decide once on disability or welfare never to move off it? And that I think that is partly a structural change. I think there will be some people who decide to stay on welfare. So I think structurally, the world around is moving to the government having a larger say. And that's part of the whole financial repression that I've been speaking about, is that governments are having a larger and larger influence on markets. And they are, to some extent, squeezing out the private sector, partly by infrastructure, where infrastructure is funded and driven by governments, but also partly by the growing social welfare benefits that are coming through. And I'm not going to even go into the debate about whether social benefits need to grow or shouldn't grow. I mean, certainly there's a need for a living wage for a number of people, but whether that can be afforded is the question. Anyway, whether it can be afforded or not is the question, and the extent of that is obviously what needs to be debated. But governments in their demand to stay democratically voted in are going to support the voters, and where those voters don't have jobs, they will support them with support their living standards. So I think there is a structural change in the world to a more social and less capitalist market. I think that there's a structural change of governments being more involved everywhere. Certainly on a monetary policy perspective, where governments are quantitative easing, governments are buying the lion's share of the bonds that they issue. Governments obviously control fiscal spend. governments are now expanding their welfare influence. So you've got a much larger share of government influence in the world, and a dwindling private sector share. That has its impact in terms of productivity, that has its impact in terms of global growth, both of which will struggle in that environment, and it's part of the financial slowdown that I'm talking about. That it has some impact on inflation, but to the extent to which that drives structural inflation, I'm not too sure. But it all again depends on the structural extent to which those welfare payments remain in place, and the size of that relative to the tax on the other side. So obviously you can't have welfare payments if you don't increase taxes. And if you increase taxes, who do you tax? And if you tax the middle class, who are the biggest spenders, and they stop spending, well then inflation will actually turn to deflation. So I'm not convinced that structural change in employment will lead to inflation. I think it will lead to lower growth. And I think it will lead to possibly, I think, more disinflation than inflation. But that's the big debate. So the world right now is debating what happens with quantitative easing, what happens in this new world where governments have a bigger say. I think it certainly impacts growth. I'm less sure about inflation. Cameron, we will be arranging, we will have our December webinar, and in this December webinar I'll be talking about the budget and all the exciting things that happen in the budget, and it will also be part of our signals that we put out. Let's see if there are any more questions while I've been talking. So just a question, so in terms of the ETF and the unit trust, is this, I'm not sure if this is referring to the healthcare one, probably the bond. So no, we don't have a bond, it must be the healthcare. So there's not much difference between the ETF and a unit trust. The unit trust does have a slightly wider mandate, so the health innovation unit trust does include a bit more growth, and it's got genomics exposure as well as our OSI exposure, whereas the ETF doesn't. At this time, a unit trust you can only buy once a day or sell once a day. 3 p.m. pricing, ETF you can buy on the market any time you want to. So those are the big differences between ETF and unit trust. Jeff, very good question on hedge funds. Hedge funds have not delivered over the last 5 years. They have delivered over the last year. So certainly, as we had incredibly positive markets, hedge funds do tend to have some beta. It depends on the market, but long short funds tend to have a 40% beta to 60% beta. So when the tide is going up, hedge funds do well. So with the great equity markets, hedge funds have done very well. So they have done very nicely. The question is whether you are paying for that beta, or whether you're paying for the alpha and expertise, and that's still debatable. I think we do think that if you can find a hedge fund manager that is prepared to only charge you for the alpha and what they produce, then we'd be very excited to get exposure to that uncorrelated return. But the hedge fund universe doesn't work on that financial model yet. So until that happens, we're not going to say anything or invest in anything. So just a quick question for Shane. Yes, no. So we don't have any opportunities. If you invest in any of our balanced funds or our global equity fund, you get exposure to the value ETFs. Locally, our Divi fund is only is SA value. So if you want exposure to global value, we don't have any global value ETFs that are direct. But if you invest in our international flexible fund of fund unit trust, or our international equity fund of fund unit trust, or any of our balanced funds, you're getting exposure to the value through those funds. Shane also asked, what are our weights in terms of core and satellite? So core and satellite a risk profile issue. So on one hand, you can take on more equity exposure as a way to take on more risk, or you can take on more cash to lower risk. At the same time, you can take on more satellite, so you get more thematic, more growth for you want risk, or you could be more index-based if you want less active risk. So we do tend to vary the core satellite ratio depending on how much active risk funds want. So generally, the higher risk appetite you have, the more satellites you have, the more equity you have. The lower the risk profile, the more cash you have, the more core you have. So that all depends on the overall fund basis. Robert asks if you should invest in a lump sum, or if you want to invest in a debit order. Markets are very difficult to time. So I always suggest at least breaking your investments up into 2 tranches and spreading that risk, because in the short term, the markets can go any way. And so the more you diversify that, the better. That said, and again, this is now completely based on historics, and it doesn't mean that it's going to happen this year, but historically, you do have the calendar effect, which means that the whole sell in May, come back on St. Leger's Day. That means the markets tend to do better November, December, January, February, March, April. They tend to do poorly May through to October. So, we should have slightly better returns over the next 6 months relative to the winter months, if history is a guide. But that is just purely looking at one factor, and there's so much more to investing in markets. But as I said, we are quite bullish over the next 6 to 12 months because of the fact that growth should continue to recover. We don't think central banks are going to raise rates too aggressively. So you've got easy monetary policy, you've got growth that will continue even if it's slowing, and that is good for markets. That said, we have moved out of the first phase of the markets, the first phase of your economic cycle, which is the recovery, and their markets rally very strongly on the anticipation of earnings growth. So you have an 80% growth from the bottom in markets on no earnings. We're now in the second phase of markets where markets wait for earnings to catch up. So now the forecast earnings have to come through, and your valuations actually decrease, and they meet somewhere in the middle. So what that means is a lot more volatility and a lot lower growth. So there your growth goes from 80% to single digits, 5 to 10% growth, as positive earnings come through and a devaluation. So we are positive in terms of markets going forward, but a lot less positive than we have been as we move into the second phase of the market. The third phase being where you start raising rates. We get to the end of the rate hiking cycle, and there your market starts to look through to all earnings decreases as the higher interest rates impact demand and the cost. So that is us for today. Thank you everybody for joining. Thank you for your questions. They are always great to answer them. So thank you very much. Have a great month, and I will see you all in December. And until then, keep a lookout. End of November, we should have our China webinar. Very exciting about the launch of our China unit trust. So please keep an eye out for that. Please go to our YouTube channel and have a look at any of the past webinars, or if you want to look at the Sygnia Equity Fund webinar, which talks about our addition of Visio to our equity range and on top of the existing AVAX 91 and Coronation. So it's a really nice explanation of our manager research process and how we go about that. I generally don't talk about that process because this is very much a market review and ecos focus, but it's a nice understanding to what happens behind the scenes and all the hard work that goes into our manager research. So that's on the YouTube channel, Sygnia YouTube. Have a look. But yeah, have a great month, and thank you very much. And we'll see you soon. Cheers.